Okay, great. Thank you so much for joining us at the finance and investment stage. And today you're going to be tuning into a panel on igniting a new era of proactive climate finance. I'm Manveer Gill, the head of sustainable business and sustainable finance lead in the thought leadership team at CDP. And I'm joined by a fantastic panel who will introduce themselves shortly to take us through what's really happening in sustainable finance as we speak. Now, there's been a lot of momentum over the last 5 or 6 years in particular around the topic of how do we scale sustainable finance? How do we scale finance to achieve the transition to a net zero and resilient future? I think COP26 in particular and all the momentum around the Glasgow Financial Alliance for Net Zero was a really critical moment, but a lot has changed since then. And I think over the last year or two, and certainly over the last few months, we've been hearing a lot more about the need for pragmatism, the need for a conversation about what the role of financial institutions exactly looks like. And whilst we've seen a lot of momentum around the question of what do we do, what do the standards and frameworks look like, what data do we need to get there, we're also seeing that finance just is not flowing at the scale that we need it to. I say all of this, and I want to acknowledge that there have been some improvements. The climate policy initiatives say that we're at 2 trillion in the last year for sustainable finance. And if we're going to get to the 8 trillion or so that we need a year, well, we're going to need to get really precise about the role that different actors play, the role of different types of capital. And that's why I'm really delighted to introduce the panel that we have here today. And I'd like to hear from all of the different vantage points that we have whilst you introduce yourself. So with that, Ray, I'd like you to introduce Energize Africa, where you're from, where the capital sits as you see it, and where are you seeing the most innovation and opportunity in climate finance right now?
Thanks, Manveer. Thank you all for joining us. My name is Ray Coyle. I'm the CEO of Energize Africa. I'm not a Halford tire fitter, as somebody commented earlier on this morning. Energize Africa is a direct investment platform. We're not a fund. So we allow individual investors, ordinary people like you, to directly invest into energy access projects and companies in sub-Saharan Africa. And what that means in practice is that companies that are supplying solar home systems, building mini-grids, supplying electric vehicles, clean cook stoves, all across sub-Saharan Africa, come to us to look for debt funding. And we issue bonds for them to retail investors in the UK on our platform. We're generally speaking issuing bonds for anything from 6 months to 5 years, and usually with ticket sizes of £500,000 to £3 million. So we're operating at a relatively modest scale, and we're funding smaller companies, small to medium-sized companies across Africa. And the reason that we do this is that there is a really critical capital shortage in Africa and across developing markets. There is the technology now available in order to enable an energy transition in developing markets to particularly solar power. There are the companies, there are the entrepreneurs, there are the logistics, and the will is all there. The problem is a really critical shortage of capital. And frequently, it's not actually an affordability problem. Many people in developing markets can afford to switch to renewable energy, and frequently renewable energy solutions are much cheaper in terms of cost of ownership over a period of time. The problem is access to capital. There just isn't the capital available, particularly in Africa. We have a lot of capital available in developing markets, so what we are trying to do is shift some of that capital to go to emerging markets. In terms of what we're seeing innovating and exciting the marketplace, lots of stuff. I think one of the really interesting things that we've been seeing just recently, it's funny you mentioned COP, is Article 6, Paris Agreement, which many of you will know, came out of COP, the Paris Accord, and Article 6 is the process by which carbon credits can be traded. Carbon credits can be purchased by developed economies and some funding can flow into developing economies. And we're actually seeing that happen in practice now. We are raising funds right now for a Kenyan company called EcoSafi, and they provide clean cook stoves to families in rural Kenya to avoid using charcoal for cooking, and they are funding their business partially through Article 6 carbon credits. So we're seeing it really working on the ground, and we're seeing families in rural Kenya getting very high quality clean cook stoves, which improves health, prevents deforestation, reduces carbon emissions, lots and lots of really good benefits to that. So it's good to see Article 6 actually working and actually happening on the ground.
Great, thank you, Ray, and we'll dig into more of that soon. Holly, over to you. Can you tell us more about your role at Schroders, and from that vantage point, where's the innovation happening right now?
Yeah, sure. So nice to meet you all. I'm Holly. I sit in Schroders Capital, which is the private markets division of Schroders. It's about just over $110 billion AUM and sits across infrastructure, real estate, private equity and private debt and credit alternatives. So a really nice kind of range and mix around what we see from a climate finance and wider sustainable investment practice. So I sit centrally for sustainable investment across the platform and then work with each of the underlying investment teams and sustainability and impact teams within our asset classes to further the products that we create, how we integrate ESG and climate within our investment process, and then more generally, like how we think about the role of, I guess, the different forms of capital that we have and how we use our levers of stewardship, for example, across them in different ways. So you get quite a nice, I guess, mix across the economy in terms of the different levers that a financial institution can have, as well as then I guess fundamentally what's the role or value creation that we seek within our asset classes and how we can link that back to the transition and decarbonisation more generally. So from an innovation perspective, I'm sort of cheating and taking multiple definitions of innovation. So from an internal perspective, for sustainable investment, we spend a lot of time looking at proprietary models. And I guess the innovation that we see at the moment is trying to route that much more back to the value creation within our asset classes. So translating it into financial metrics, for example. So climate adaptation is an upcoming topic for us where we're looking at trying to quantify that internally, different activities and how much they contribute to an avoided loss scenario. And one's around translating, I guess, ambition or climate ambition across our asset classes. So trying to build out some of our sort of cross-asset class frameworks for decarbonisation and net zero alignment. On the things that we finance, again, like quite a varied selection, but maybe just to highlight, I guess, our infrastructure business called Schroders Greencoat. We have a pretty steady sort of wind and solar offering, but what we've been doing more so is expanding our energy transition platform. And so we have investments across things like green hydrogen in the UK, as well as looking at sort of green digital infrastructure. So we have a project that's based in Ireland, which is a much around sort of providing a data center with renewable energy, so becoming, I guess, a site that has multiple purposes, and that's also a sort of regeneration story. It's an old industrial site at the moment, so there's a sort of uplift of land on that as well.
Great. Okay, so we've heard of some really exciting innovation happening, some timely topics as well around Article 6. No doubt you've heard the word adaptation a few times over the last few months. Over to you, Jinwei.
Hi, everybody. I'm sure there are quite a few of you out there, but I can't actually see you, so apologies. Right, good morning. My name is Jinwei Tan. I work at M&G, and I am the head of ESG in our life company, so the asset owner entity. And my job is to really look after ESG investment strategy for our flagship life fund, as well as some of the products we sell. If any of you remember the man from the Pru, or have bought anything from the man from the Pru, yes, we manage your money. So innovative capital and in finance. Well, I think something old has now become new again, and that's really stewardship. And it's been a hard journey, but we are finally seeing stewardship actually have an effect. And part of that is due to resource stewardship teams are now larger, and also willingness to be quite frank and ruthless with the companies we invest in. That you see quite a number of examples of escalation today, directors not being voted for, and resolutions around climate finance and climate transition plans failing because shareholders today are much more willing to deploy the power they do have.
Okay, great. Thank you, Jinwei. And as I heard you all speak, I realized I didn't introduce CDP. So a little bit on us. We run the world's disclosure platform, and we have data from over 23,000 companies, cities, states, and regions. On the listed equity side, that's covering 2/3 of market cap. And as I hear you all speak, I'm really hearing that there is a lot more than just the listed equity side to speak about. So I think we're going to hear about certainly some of the mature angles that we might have in terms of taking that data and shifting that into sustainable finance. But we're also going to hear about some of the other asset classes where it's not quite as simple as just getting a TCFD-aligned disclosure, for those of you that are familiar. Now, I suppose, Ray, when I heard you speak in particular and speak about the work that you're doing in Africa, I think it's worth heading back to the Paris Agreement for a second. The role of sustainable finance, the role of consensus, a whole of economy approach to get us to where we need to be, necessitates that we take everybody on that journey. And trust is a really critical element of the COP process, and getting the consensus that will get us to a point where it's not just a case of the EU leading the way or Japan having a sovereign transition bond. It's every single market that needs to transition. So how does that actually look in practice for developing markets? That's where I want to take the conversation next. And we know we need to scale into the trillions. So I want to look at how we move the big money. And with that, Jinwei, let's start at the top. How do we move the trillions to where it's needed in developing markets? And what's actually getting in the way?
Well, I guess if you look at the funding gap, I think developing markets probably get something like 10 to 20% of what they actually need. And so the funding gap is probably hundreds of billions in terms of order of magnitude. Now, there are reasons for this. And from my own perspective, I think one of the key reasons is that the returns don't really stack up. We're no longer in a zero interest rate world, and so the search for yield isn't quite as difficult as it once was, and that would have been a major incentive to allocate to transition finance in emerging markets. But these days, for the first time in my career, Japanese government bonds are a yieldy investment. So the hurdle rates are that much higher. And I think one other reason is that actually credit risk is awkwardly priced. It's priced essentially a backward-looking basis. Credit ratings are important. And frankly, counterparties in developing markets don't get the credit ratings that they probably need to attract investment from developed world asset owners. And I think finally, it's really hard, actually, to invest in developing markets, and it's not easy. I think if you look at the operational complexities, the thinness of some of these frontier markets, how you get your currency in or out. Sometimes you take a 25% haircut just to get in. So you have to get in size, and you have to also contend with the fact that by getting in size, you might actually move the market. And so it's not a simple exercise to invest in transition finance in a developing market.
Okay, so that paints a little bit of a bleak picture because there's some challenges that we need to get across. And we heard about credit risk, credit ratings, the question of return on investment. What's going to actually make this investable? And that's why I'm glad, Ray, that maybe you can actually just talk to us a little bit about all the work you're doing on energy access and where you are seeing some success in driving investment in Africa.
Yeah, sure. And just to put this all into context in terms of the amount of money and the hill we have to climb for energy access. So the population of Africa at the moment is 1.6 billion. 600 million of those people don't have access to electricity. The population of Africa is forecast to increase by 2050 to 2.5 billion. And all of those people are going to want access to power. So that's 1.5 billion people over the next 25 years that are going to need access to power. Now, if those 1.5 billion people all get access to electricity through diesel generators, there are 6 million diesel generators in Africa at the moment, roughly. If all of those 1.5 billion get access through diesel generators, then everything that we are doing in Europe is a complete waste of time. It will all be just massively offset and then more by increased emissions in Africa. This is a global problem, so we need to tackle it globally. So that's the scale of the problem that we're facing. And Jinwei, you're absolutely right, the shortfall is huge. The total investment that went into energy access in Africa in 2025 was just over $350 million. So trying to move trillions, we need to get to billions first. The challenge is very, very substantial. But there are solutions, there are ways in which this can be done. And again, I totally agree with you, risk is a big factor, and trying to get risk-adjusted returns is a big factor. And the solution to our mind is that the risk needs to be spread. We need blended finance. So what we need to do is we need to take elements of DFI, of government investment, we need to look at World Bank funding, we need to look at private capital, debt and equity funding, and we need to create blended finance structures that reduce the risk to a degree that is acceptable for private capital. And just to give a real-world example, we're currently funding 19 green mini-grids in Bauchi province in northern Nigeria, and we're providing the debt funding for the construction. The grant funding is coming from a World Bank program that's managed by the Renewable Energy Agency in Nigeria, in Abuja, and that's a results-based finance program. So the World Bank is reducing their risk by only paying out on a results basis. They will pay out when the mini-grids are commissioned and built, and that reduces their risk. We will fund the construction, and that reduces our risk because we are not exposed to local currency risks, because the World Bank RBF grant will pay out in dollars, and we're not exposed to longer-term project finance. We're just taking construction risk, which we feel comfortable to do. We have a very experienced team. We know a lot about mini-grid construction. So the solution is blended finance, combinations of finance, and getting that risk to sit with the different elements of risk spread across different organizations, so that the different elements of risk can sit with the organizations that are comfortable with that element of risk. And that gets us a return on that particular investment. That gets us a return of 8% on 2-year debt funding for construction finance, which is a reasonable return for the debt funding. But it does take an amount of work, and it takes an amount of effort to structure these projects so that our debt goes in alongside equity and goes in alongside the same time that the grant is agreed, and that the grant then pays out on completion of construction and commissioning. So it can be overcome with a blended finance approach and a mix of DFI, public money, equity, and debt.
Great, thank you, Ray. And so I think we've just gotten into the detail there of what it takes to actually get money on the ground in Africa, certainly. Holly, over to you. I want to hear a little bit more about how we get the likes of Schroders and some of that institutional capital into the mix.
Yeah, I mean, I think Ray really nicely teed it up for me, and I promise it wasn't coordinated. But so I guess 2 examples that we have for Schroders. So Schroders has an emerging markets impact specialist called Blue Orchard, which basically directly crafts predominantly private debt strategies that are blended finance. So that blending of different types of capital with different tolerances of risk is exactly what those products target, and they're looking at emerging markets in its entirety. And then we also take that, I guess, emerging market risk and mix it with other asset classes and developed markets within our multi-private asset solution business. So rather than, the Blue Orchard funds that we have are smaller in size, so they are more difficult to access for certain types of clients. And so within our sort of solutions business, we take that complexity almost away from the end client and we do it within ourselves. So we then run two sort of multi-private asset solutions. Both of them have a predominant focus on climate. They're about 70 or 80% exposure on the climate or environmental side. And both of them then have some form of exposure into emerging markets through that, but they're blended internally with then other asset classes and other exposures to take away and, I guess, offer to big institutional investors a sort of multi-private asset product that speaks to maybe the types of themes, sustainable investment themes that they want to have exposure to, but that complexity around different asset classes or different regional exposures is sort of done by the manager rather than the end client. So those are sort of, I guess, two ways in which we have it.
Okay, great. And with all of that, I suppose I'm hearing a lot about transition in particular and the work around renewables. It'd be remiss of me to not mention the word adaptation in a bit more detail, given I don't know what your commutes were like today, but I was not comfortable. And we're lucky. We've got AC all over the place. Now, what does it take on the ground to ensure that some of these projects are going to be resilient when it comes to adaptation and to physical risk? And with some of the deals that you're looking at, do any of you have anything to add there in terms of how you're securing the future of those projects?
I'd like to pick up on the resilience point, and in terms of making the companies that we invest in resilient. And there's a company in Democratic Republic of Congo that Blue Orchard has invested in, and Energize Africa has also invested in. A company called Altec, amazing business. It was set up by two refugees, Washikala and Iongwa. We've been working with these guys for years. And they were refugees in Tanzania from the previous Congo war, and they went back to the Congo to set up an energy access business. It's now got 3,500 employees. They've brought clean energy to 2.5 million people. And when we talk about resilience, these guys are resilient on a different scale. The headquarters of Altec for 8 years was in Goma. They're in North Kivu, in the Congo. It got invaded by M23 rebels. So the companies that we're investing in, that's what they're capable of dealing with. So in terms of the actual organizations, they are incredibly resilient. The communities that they serve are not. And the communities that they serve are far, far more exposed to climate change than we are in Europe. And we are seeing at the moment a confluence of circumstances in sub-Saharan Africa, the combination of lack of fertilizer because of the closure of the Strait of Hormuz, more unpredictability in climate, and also the effects of the El Nino that we're expecting to see the later half of this year is going to lead to extremely difficult circumstances in sub-Saharan Africa. But there are things that can be done in order to help address that. We've invested in companies that supply solar water pumps to smallholder farmers, and that enables people to increase agricultural yields and gives people some protection from the effects of climate change. And that's the kind of adaptation that we need to see more funding for and more funding flowing into. And again, it's about this capital shortage. Smallholder farmers can afford to pay for solar water pumps because they will get greater yields from their land, they'll get more crops, they'll have more money. So they can afford to pay for it. What they can't afford to do is pay for it up front now. And getting back to the example with Altec, so Blue Orchard is providing Altec with funding so that they can supply products on credit to their consumers. And that's really, really important in order to be able to enable people to afford things. So it's about getting the right products in people's hands so that they can make the changes they need to do to adapt to climate change, but also getting them to people in the right financial structures so that people can afford to pay for them over time. And we've invested in Altec as a supplier of equipment, because that's what we invest in. We provide inventory finance. Blue Orchard is invested in Altec as effectively a lender, because they provide these products on credit. So I think it's really important that we think about not only the solutions, but how those solutions are made affordable for the people who need them.
Okay, great. Holly, it looks like you've got something to add.
Yeah, I was just going to say, so I guess, as Ray said, we both have this sort of overlapping company investment, and for us, a lot of the framing's actually around financial inclusion. So a lot of our emerging market almost starts from a financial inclusion perspective, and then it'll have an environmental or social objective with it as well. And I think in emerging markets, we're largely talking about access. And I think access means something very different in developing countries than it does in developed. So, Ray's example around the right form for smallhold farmers, small businesses, is something that we think about a lot within both, I guess, mitigation, but also on that adaptation side. So we manage some emerging market private equity funds, and they are looking across basically climate insurance or the protection gap within emerging market countries. And so what we're doing there is we're not thinking about it as the same as developed markets in the sense of an insurance sector and a reinsurance sector and maybe a capital market sector that all sort of flows between them, because we're starting from a base where there is no access and there's no system there to support them. So some of our investments within those funds actually focus on what businesses are already serving those communities or individuals. So that could be, a small lender, something that is digital based, or an online platform where smallhold farmers currently purchase their seedlings, and looking at whether those companies could also have an insurance mechanism within them. So we invest in them because they are already touching or accessing the types of communities or individuals that we want, and we're then using sort of technical assistance facilities to then educate and bolt on almost that insurance coverage. So the affordability is there, but you already have some form of access. And then more generally, we're looking across in terms of, do we have fundamentally a good understanding of physical risk within emerging markets as well? So when we're talking about data collection, modeling, a lot of that, and even the insurance industry and the sort of expertise that they carry, a lot of that is still focused or built out within a developed country context. So do we actually fundamentally understand and correctly forward predict risks within emerging markets? So we look across both, I guess, like access to individuals, forms of access from an insurance perspective for extreme weather, and then also can we invest in companies that are assisting with the correct level of understanding or quantification of risk, also for emerging markets to conceptually understand it across the value chain.
Okay, so really getting quite real here. Jinwei.
Yeah, can I come in? I'd like to come back to physical risk and how we tend to look at it. Just give you an example. I was pondering the difference between adaptation and mitigation today on my commute in, and it struck me that mitigation is if you carry a portable fan to cool yourself. Adaptation is wearing a t-shirt. So I did neither today, so I neither mitigated nor adapted to the heat wave. But having realized that, I'm sure I'll be wearing something different tomorrow. But physical risk is hard to model for precisely that reason, right? The solutions come out of nowhere, and probably you only realize what they might be once you face it. They also pop up in different places, and one of the things I'd like to just highlight is that physical risk is not only about facilities and your factory and where they might be. It's also about people. I'll give you an example of this. I was doing a project a couple of years back with my colleagues in India. Our office is in Mumbai. So I was on a Teams call with a colleague and he said, I'll be offline for a couple of days. I'm going to try to make it into the office. I said, why? What's wrong? He said, there's flooding. And there was no flooding in Mumbai at the time, so I knew that. But it turns out that he lives in Udaipur, which is 14 hours train journey away from Mumbai, and there's flooding in Udaipur. and he was going to try to make it into the office so he could continue working. That was a 14-hour train journey for him. There was a physical risk there, all right? Exposure to flooding in Udaipur. We didn't really know about it, certainly I didn't. But how do you measure these things? How do you capture these things in the risk register? And I think as a long-term investor, it's certainly something we now look at with companies, try to improve your risk monitoring, your risk measurement, and most importantly, your risk reporting. So yeah, big topic, but yeah, share some thoughts there.
Thank you. When you just mentioned risk reporting, and we did some research at CDP looking at all of the disclosures of companies that tell us precisely what financial risks they're exposed to and how that's being driven by extreme weather events. And what they told us, of the companies that have the maturity and the ability to start to quantify what this is going to look like on their balance sheets when they're hit by a flood or a drought, that they expect over 700 billion in anticipated financial effects, that's in line with ISSB disclosures, to hit their balance sheets over the next, primarily actually, the majority of that over the next 2 to 3 years. And I think what we're hearing here is that there is this really complex story, both in terms of the human side, which I think is not really being priced in at this stage, the complexity around avoided losses and how you actually ensure that there is sufficient incentive for the investment needed to combat some of these physical risks. And I suppose with that, I just wanted to check, because I know, Holly, you mentioned at the beginning that you're doing a lot of work zooming out of emerging markets around adaptation of physical risk. Could you tell us a little bit more about that?
Yeah, sure. So we're doing, I guess, both on the solution, I hate to say opportunity side, but opportunity side, and also on the risk side. So on the risk side, I guess, in private markets, we've been focusing mostly on our modelling within real estate and infrastructure as the two areas kind of more exposed based on their sort of, I guess, they have assets, on their exposure to physical risk. And we've been doing like a kind of, I guess, a scan of the market in terms of specifically modeling asset types. So we're not asking for a spot location or you to tell us what the exposure is of a location. We're asking for where we can have a model that we input numerous specific details of an asset, whether that's a type of building or an infrastructure asset, and for the model to correctly reflect the features of it. And that's something I think we are shifting or have progressed well on. I mean, there's lots of geospatial and modeling specialists that are doing that. But I'd say I don't think we've reached a point where all of those asset types are really sophisticatedly modeled, to the point that then we feel really confident within the results. So within our real estate business, we've onboarded a geospatial provider about 18 months ago. On the infrastructure side, we've actually developed our own with a consultant on the basis that we didn't feel like that kind of range of asset types that we had was something that we could just kind of lift off from an existing external vendor. But actually what we're doing is, so we have an insurance-linked securities business at Schroders Capital as well. And what we're trying to do actually is to take what is already quite a good model for short-term risk, 1 to 3 years, that the insurance industry does already and prices that risk, and try and translate that type of, I guess, like modeling or intel from that part of our business into other areas like our real estate and infrastructure businesses, because the insurance industry already, like we have a range of modelers that exist within our insurance-linked securities business. They use sophisticated models. They're happy to price that risk. And how do we basically take that intel from an existing industry and sort of shift it into us as an asset manager and other asset classes? Because I think sometimes we talk about them as if they're quite different spaces, but they're still trying to target the same problem. The only difference is with the insurance part of our business, we're working for like risk exposure on a 1 to max 5 year basis, mostly 1 to 3. Whereas within our other parts of our businesses, we're trying to consider both those shorter term extreme weather event risks and our long term exposure to like chronic climatic change. So that's a slight difference, but we're trying to take a lot of what the insurance industry or feel the insurance industry has already done and shifting it into the other areas of our business that we're trying to answer the same problem but from a different angle.
And that geospatial data is really, really important. It's come on in leaps and bounds in a very short period of time. It's actually amazing that the detail of geospatial data you can get now for very rural parts of difficult regions to reach in Africa. The WRI, the World Resources Institute, has been very well funded by the World Bank and has a very, very advanced model now. So when we're funding to somebody to construct a green mini-grid, for example, our due diligence team can zoom down to the individual village, to zoom down to individual buildings, and we can see weather history, flooding history, we can see flooding likelihood. So the data that's available is really quite incredible compared to only a few years ago.
Okay, so the data's getting better, and hopefully that's going to be a trend that we speak to as we move into our next segment. And so this is our final segment, and I want you to think about what we've been saying and start to prepare some questions, because we will have some time for that at the end. Now, we've been speaking a lot about developing markets, around adaptation, and on this last segment, I'd really like to focus on transition finance. So when it comes to hard-to-abate sectors, we have really seen that whilst we've got great progress around renewables, some of the sectors that are going to be absolutely critical to decarbonize if we want to meet the goals of the Paris Agreement are not getting the finance they need just yet. And there's been a lot of work from across industry bodies to get us to a point where maybe we start to see that finance scale, where we start to see companies in these sectors have transition plans that can ultimately decarbonize and see their financial planning align with those goals. At CDP, we've seen, though, that's not necessarily happening right now. So we had a look at all the companies disclosing to our large and medium-sized questionnaire. That's about 12,000 of them. And we saw that 72% of those companies had some kind of emission reduction initiative. Fantastic. They're doing something to decarbonize. But only about a tenth have any kind of capital expenditure that's aligned to their transition plan. So that's the kind of financial planning that's actually going to result in investment in the technologies that are going to decarbonize their sectors. And so with that, we're seeing that transition finance is falling a little short right now. And Jinwei, I want to turn to you first on this and understand, do you think it's falling short? And where do you see any of the problems there?
Well, I think the word transition is perhaps slightly overused. It captures a lot of things and quite a lot of messy things. I would consider a capex plan that requires debt financing that is aligned over 20 years, let's say, with Paris Agreement. That, to my mind, if you financed it with debt or equity, those instruments might be called transition finance. But there's a lot of stuff that currently attracts a label that probably doesn't fall into that category. So I think you have to be careful as to what you're buying and how you plan. And if you want to attract a transition finance label, I think you have to make sure that it is indeed transition aligned.
Okay, thank you. And on the private market side, Holly, where do you think the bottleneck currently sits, and where are you seeing some reasons for optimism?
Yeah, so, I mean, maybe just on the definition point, I think you've got quite a mix of what we mean by transition. So you can take the premise that every company or asset can transition, and you can look at, the transition plan regulation in the UK, sort of under discussion. You could look at industry frameworks that model or assess a company's commitments and progress against those, and that would be the framework that every company can go through some form of transition. You can actually bolt on adaptation as well. You either decarbonize or you make a business more resilient from a physical risk perspective, or you're going to ring fence down into then a set of activities that you're identifying as requiring a significant form of transition. So high emitting for mitigation would be those, right? They're identified as high contributors today and requiring transition. Or the other one is that, we're going through an energy transition. And so if you spoke to our infrastructure business, they would talk to you about renewables under the term of transition, because for them, it's fundamentally looking at the energy transition. And so then the suitability is on renewables, as opposed to a ring fence from a taxonomy perspective that would never include those as a transition activity. I think what Jim Wee said around what your financing is doing is probably the neatest way to think about transition. Is it incentivized through the structure that you have in place? So in our infrastructure debt, does it have some form of sustainability-linked loan incentive through the structure that's encouraging transition? Or is it is the way in which you're assessing the company from a financial perspective part of your investment thesis is that by undergoing the transition, value is created in that company or asset, and that's why you've invested in them. That's the root of what you're looking at. So the easiest ones in private markets, generally we look at uplifting the buildings that we invest in. They're not green buildings just from the off. They're not end state. They require a transition and uplift. And so we might implement sustainability components, but actually they're part of a wider thesis around that asset uplift and the value that we think that asset is going to have over time or change over time. And for me, that's really where we try and sort of root what that transition is. It's either through that structuring incentive or fundamentally where we see the value being created, which is maybe slightly more focused than every company can decarbonize. Not to say that it wouldn't have a financial benefit from it, but we try and root it back to the investment and sort of value creation thesis that we have.
Okay, and maybe just a follow-up for both of you, because obviously it's hard for me to know who exactly is in the audience, what your backgrounds are, but for those of you that are familiar, there's been an absolute proliferation of standards, frameworks, guidance over the last five years or so in particular. And I think there's also been a lot of work to standardize across the board and to drive some convergence. But devil's advocate here, of course, at CDP, we think that those standards and frameworks are important, but do you think that they are really helping? Do you think that disclosure standards, the likes of the ISSB, do you think that the proliferation of taxonomies across jurisdictions are helping? What would you do differently, or what is supporting your work?
So on taxonomies, I would say it depends what you want to use the taxonomy for. So for background, if you took the EU taxonomy, they obviously they categorize activities across sort of general, which I consider like basically low carbon, transition or enablers, which is a really interesting starting point in the sense of ring fencing those activities which should be prioritized to undergo transition, simplistically. But then if you shifted it from the list of activities into the sort of the technical screening criteria, so how you have to qualify each of your investments, the qualification criteria is the end state of your transition. So if you took a transportation activity that sits in the transition category, the qualification criteria is, zero tailpipe emissions. So it's a great assessment of the kind of green end of what is being identified as a transition activity. But if you are wanting value through the transition, you are not going to look in the taxonomy technical screening because it's already gone through the sort of greening aspects. It's not a signal of a company undergoing transition. Versus if you took the Singapore taxonomy, which has a traffic light system, so it has the green qualification screening criteria that you see, but for those that is identified as needing a step change, it also has yellow qualification criteria. So that would be signaling your move across or transitioning downwards rather than just your end state. It's not to say that none of them, so we look at across government taxonomies and industry taxonomies, how activities are categorized. And that, I think, from a regional perspective is really interesting. So what does Singapore or an Asian-based taxonomy identify as a transition activity is sometimes quite different from what the EU does. And for us internally, that's then a discussion around the regional requirement of different activities, different areas of financing, because something that is if Europe has already undergone some form of transition, it doesn't then think of the same activities as needing the capital. So for us, that cross comparison is really interesting. But I think with sort of upcoming regulations, changes to SFDR and the sort of SFDR 2.0 and the sort of discussion around a transition label, I think for us personally, we're going to have to be very clear with how we define transition internally to qualify for those types of labels in the future, and have a very clear framework in how we assess it, just because the market has these sort of different ways of thinking about transition, different ways of ring fencing, and I think evidencing our contribution of transition maybe is easier in private markets where we directly manage assets. We can evidence what we're doing from a transitioning of that asset over time perspective, but you're going to have to be very clear at what time frame you expect transition. So if we hold an asset for 8 years, we might not be able to evidence externally any uplift on an asset for 3 years. We could be evidencing, I guess, the spend, but from a results-based or outcome-orientated metric, we're going to have to be clear that it's an 8-year plan, and actually we might not be able to give you much output change for 3 years. So I think it's going to require a more clear sort of output-orientated articulation, and how you've defined that transition bucket for each of us as managers. Sorry, long-winded.
I think there is an inherent conflict when you try and get into these definitions between bringing consistency, which really helps in terms of communication to investors and in being clear and consistent, but it doesn't necessarily help the investee companies if you're talking about different marketplaces, and particularly when you go into emerging markets. Taking our EU definition of transition and saying that should apply equally in DRC, in Kenya, in Nigeria, doesn't really work. So we're going to have to work out what the balance is between having appropriate expectations leading to definitions, leading to terminology for emerging markets, versus consistency in describing the investment classes.
Okay, great. Chinwe, was there anything you wanted to add on that one?
Yeah, there's probably a couple of points I'll make. I think one of them is that there's probably too many of these taxonomies, acronyms. One would have probably been plenty. But the other point is that actually these taxonomies actually do reflect the priorities of the governments who create them, and they are quite different. But what that means is that you can't really pool capital across these different jurisdictions. So I couldn't take my fund, which is probably aligned to the EU taxonomy, I'd say, and sell that in Singapore. I can't, because it's not. It just doesn't reflect the right regulatory priorities. I have to create a new fund, which means my customers in Singapore are not really getting the benefit of scale with my customers in the UK and the EU. So that's a problem to resolve, and maybe the industry should ponder a little bit about that.
Okay, well, for those of you that are not following the COP process as closely, you'll be glad to know that there is some work going on to try and get some more consensus on the taxonomy side. So the Brazil presidency at COP30 announced some work around a super taxonomy and really trying to understand what equivalence looks like. So hopefully that will help address some of the challenges that we've heard about implementing this for investors. Now, I'm being ushered for time, and I want to make sure we have a little bit of time for at least one question, if not two. I might try and push us here. But before I do, I just want to close out and give our panelists 30 seconds each to see if there's anything that you want to wrap up on, and if there's one type of capital that you want to see do more over the next couple of years, in particular to scale into the billions, into the trillions. How do we get there? Over to you first, Ray.
One type of capital, yours. Come and see us. We have a stand just out the back here. Come and talk to us. We would like to talk to you directly about mobilizing more private capital in order to bridge that capital gap and bring more clean energy to more people in sub-Saharan Africa. So come and have a chat.
Holly?
Maybe I'll just cover one that we haven't discussed. So we are increasingly looking at enablers, mostly actually within our private equity business, which does sort of small to mid-sized company buyout. And we just think generally enablers is like the category that's discussed even less than others. So it enables through products and services, indirect decarbonisation. We think it works particularly well within the private equity part of our sort of asset class mix, partly in infrastructure, and it's basically unlocking critical bottlenecks within the current system. So, you know, we talk about the onboarding or the expansion of renewables. We invest in companies, for example, that service those domestic solar, for example. So if you look at some studies, you know, if you don't correctly service your solar panels, you can lose about 10% of your energy each year through inefficient generation, for example. So we think those types of bottlenecks, grid access is another one that's spoken about a lot. So those are, I guess, what we're quite excited about in terms of they're underappreciated. They tend to be asset light, emissions, well, mostly emissions light as company profiles, but they are critical to unlocking parts of the system. And we just don't think they're sort of covered as a topic or theme area that much. So that's my area of interest.
Thank you. Jinwei.
Yep. In fact, one wish, a wish for more government capital to come in and take the first loss piece, instead of competing with asset owners for the more senior, more secure tranches. So, yeah, hope someone in the government's listening. Thank you.
So I think there's probably some entire separate panels that we could have on enablers, even on Article 6 we didn't get to touch on in as much detail, and of course
I'd love to talk about the government money as well. The first laws, yeah, completely with you there.
So maybe you'll find us in the fringes if you want to carry the conversation on there. We might have time here for one question, and I want to see if there's a chance to pass a roving mic around. Does anyone have a question? If you want to put your hand up, if there's anything you want to ask this panel, and if so, we'll hand over to you before we wrap. And if not, and you just want a drink of water, that's very understandable at this stage. I don't see any hands up, and so I think that might just be a good point to wrap, because we're at time. So I wanted to thank our panelists for joining us. I want to thank you, the audience, for tuning in, and enjoy the rest of your Reset Connect.
Thanks for coming along.
Thank you.